Hello, my name is Katie Kelly. I'm a Senior Director working on the end of Libor transition and the transition to risk-free rates for some time now, as well as other functions at ICMA. But this is a project we've been familiar with for quite a long time and we're very, very close to. It's quite difficult to know what level of understanding people have of this subject, especially when they're not so close to the region. So I'm going to go through a lot of background about the transition to risk-free rates, and apologies if you're already aware of all of this, but already I've received some questions which indicate quite a varied degree of familiarity. So hopefully it will be pitched just right, but please do send questions in as Ravina has suggested, or if anything isn't clear, please contact me after the presentation. My contact details will be featured at the very end. I'm mainly focusing on the sterling market in this presentation, with some read across to the US dollar market and in some cases Japanese yen and euro area. I'm mainly focusing on bonds, for these purposes I mean floating rate notes, covered bonds, capital securities and securitizations. And I have broken down the subject into 4 parts. So the first part is going to be the need for risk-free rates. The second part is the relevant timings for cessation of Libor. The third part is the risk-free rates themselves, how they behave and progress with their adoption. And the fourth part is the challenge associated with legacy transactions. Part 1, the need for risk-free rates. So Libor has always been based on submissions of interbank lending from a panel of banks. But over the years, and due to limited activity in the interbank lending market, which it purports to measure, it became very clear that submissions were excessively based on expert judgment of panel banks rather than actual transactions. And this then made Libor become a more subjective rate, which was difficult to substantiate and also made it prone to manipulation. And because of this, its reliability and integrity were questioned. Andrew Bailey, who was formerly the chief executive of the Financial Conduct Authority, but is currently the governor of the Bank of England, made a very important speech in July 2017, which was seen to be a turning point in the future of Libor for the markets. Since then, regulatory authorities globally have consistently been stressing the need to move away from Libor for some time, and that the best way to minimize the Libor transition risks are firstly, simply not to issue any new bonds linked to Libor, and secondly, to actively transition any instruments that are already linked to Libor and will mature after the relevant cessation dates. The currency working groups, I'm just going to say a little bit about these. So the official sector-sponsored working groups were established to recommend robust alternative risk-free rates for all Libor currencies and to assist stakeholders with the transition from Libor. In the US dollar market, the working group is the Alternative Reference Rates Committee, or the ARC, and they've recommended SOFR, the Secured Overnight Financing Rate, which is a broad measure of the cost of borrowing cash overnight, collateralized by US Treasury securities in the repo market. In the sterling market, the working group is the Sterling Risk-Free Rates Working Group, and they have recommended SONIA, Sterling Overnight Index Average, which is based on actual transactions and reflects the average of the interest rates that banks pay to borrow sterling overnight from other financial institutions. In the Japanese yen market, the working group is the Cross-Industry Committee on Japanese yen interest rate benchmarks, and they've recommended TONA, the Tokyo Overnight Average Rate, which is a transaction-based, uncollateralized overnight call rate. In the euro area, Euro Libor is not really used widely in the bond markets. Euribor has been reinforced, but it's not due to cease anytime soon. Aeonia, the other rate used, is however ceasing and will be replaced with Euro STR, which is a new rate which is based on money market statistical reporting of the euro system. ICMA's involvement, we've been involved quite heavily in a lot of the work globally since the start of LIBOR transition. We are a member of the Sterling Risk-Free Rate Working Group, and we chair a subgroup focusing on bond market transition. We are also a non-voting member of the Working Group on Euro Risk-Free Rates. We participate in the National Working Group on Swiss franc reference rates, and we regularly discuss the relevant issues with our counterparts in the ARC in the US. We also keep in close contact with our peers in the Loan Market Association on developments in the loan market and with ISDA on developments in derivatives. So that's just a bit of background about what's been happening and how we are associated with the transition from LIBOR. I'm now going to talk about the relevant timings which have been set for the cessation of LIBOR. On the 5th of March 2021, the FCA announced the future cessation of 26 LIBOR benchmark settings, which are currently published by the IBA, ICE Benchmark Administration. Now you'll see from the slide that publication of all 7 Euro LIBOR settings, all 7 Swiss franc LIBOR settings, the spot next 1 week, 2 month and 12 month Japanese yen LIBOR settings, and the overnight 1 week, 2 month and 12 month GBP LIBOR settings, and 1 and 2 month dollar LIBOR settings will all cease immediately after 31st of December 2021, not long to go. Publication of the overnight and 12 month dollar settings will cease immediately after 30th of June 2023. They were supposed to cease at 31st December 2021, but given the magnitude of the legacy problem in the States, this was extended for 18 months. Now that leaves 9 remaining LIBOR settings, which are the ones which are of main use in the bond market and in financial markets generally. And they are 1 month, 3 month and 6 month settings of dollar, sterling and Japanese yen LIBOR. The FCA has also stated that those 9 LIBOR benchmark settings will no longer be representative of the underlying market and economic reality that they're intended to measure, and that their representatives will not be restored. We'll come back to this later. So now we're going to look at the risk-free rates, how they behave and progress with their adoption. So as mentioned, the risk-free rates that have been nominated are SOFR in the dollar market, SONIA in the sterling market, Euribor is staying the same, and Ionia is becoming Euro STR. It's fundamentally important, though, to consider the differences in how LIBOR and these risk-free rates operate. And there are 2 key differences between LIBOR and RFRs. And that's term and credit. Looking at term first of all, LIBOR is a forward-looking or term rate quoted for 5 currencies and 7 tenors. In the bond market, the most commonly used tenors are 3 months and 6 months. And importantly, the LIBOR-linked interest rate payable on a bond is known at the start of the relevant interest period. Now, all the alternative RFRs, which have been identified by the currency working groups, are overnight rates, which have already happened. So that means that determination of a 3 month or a 6 month rate based on the alternative RFRs requires significantly different mechanics to those used for determination of a LIBOR-based 3 or 6 month rate. We'll take a look at this in more detail later. The second difference between RFRs and LIBOR is credit. The LIBOR methodology is designed to produce an average rate which is representative of the rates at large that leading internationally active banks with access to the wholesale unsecured funding market could fund themselves in such a market for particular currencies and in certain tenors. Now, it therefore incorporates a bank credit risk element, and this additional subjective credit risk element is not observable in the alternative RFRs. Again, we'll come up to this later in the presentation. So looking at the RFRs in practice and using them to construct a periodic payment, interest in bonds is typically paid periodically. But as the RFRs are overnight rates, they must be aggregated in some way over the relevant period to determine the interest amount for that period. For that purpose, they can be constructed for use in bonds in different ways. They can be compounded in arrears, compounded in advance, averaged, or used as a component of a term rate. In the SONIA referencing bond market, the consistently used convention has been to aggregate the daily SONIA rates on a compounded in arrears basis, which requires observing SONIA on a daily basis over a period corresponding to an interest period and compounding it over that period. This is the rate that's been used in all SONIA-linked bonds and securitizations issued in the sterling market. SONIA compounded in arrears aligns with the conventions already used in the SONIA swap market and with the fallback rate for derivatives, which is included in the ISDA Fallbacks protocol and Fallbacks supplement. We'll get to that later as well. So consistency between the existing SONIA-linked bond market and the derivatives market is considered to be very desirable and should give rise to fewer instances in which instruments used to hedge cash products need to be amended or excluded from the ISDA Fallbacks protocol. The UK regulators are very keen that the market moves wholesale to SONIA compounded in arrears, and indeed it's the recommended successor rate to sterling Libor in certain bond fallbacks, which we'll discuss later. Compounding in advance has been used in the US. In fact, in the US, the methodology that they've used to aggregate SOFR has been mixed. Some transactions have used simple averaging, some have used compounding in arrears, but many have used compounded in advance. And basically it means taking the interest period and taking the rates, but applying it to the next following interest period as opposed to the current interest period. So we need to take a look now at the conventions which associate the RFRs, the risk-free rates. And in the SONIA market, the conventions which have been used involve referring SONIA compounded over arrears over an interest period with a margin added and a lag mechanism in respect of each interest period, so that the SONIA rate used to calculate a rate for each day in an interest period is based on a SONIA rate for a prior day, or typically 5 days prior. This is called the lag methodology, but a shift approach can also be used. The shift approach is similar to the lag approach, but the compounding formula in the shift approach weights the SONIA rate to account for the calendar days when the SONIA rate is not published, according to the number of days that apply in the observation period, whereas the lag approach weights the SONIA rate according to the number of days that apply in the interest period. Issuers can continue using either the lag approach or the shift approach. In the SOFR market, no one particular convention has emerged as a clear standard. Some have used a lockout mechanism whereby one of the daily SOFR rates is suspended, meaning that it's repeated for several days, typically at the end of an interest period. And some have used the lag or look-back approach, and some have used the shift approach, and others have used a payment delay mechanism, whereby payment dates can be delayed for several days after an interest period concludes. We are looking at the indices here for the risk-free rates. In the US, the Federal Reserve Bank of New York publishes a SOFR compounded index and SOFR averages, which are derived from daily compounded SOFR for 30 days, 90 days, and 180 days. In the UK, each of the Bank of England and IBA, ICE Benchmark Administration, publish a daily SONIA compounded index. Now, in practical terms, use of these different indices are generally compatible with any financial product that uses a shift methodology. Other indices are under development in other markets, such as Euro STR or the Turkish market, Canadian and Singapore risk-free rate markets. Now, this is looking at term rates, and Libor, as we've already said, is a forward-looking or term rate, where the Libor-linked term rate payable is known at the start of the relevant interest period. And in the SONIA referencing bond market, term rates have been developed. However, a lot of work has been done by a term rates task force in the sterling market, which has concluded that term rates should really only be used in a very limited number of cases, such as some loans and in Islamic financing. However, the term rates will form part of a legislative solution that has come up with for legacy Libor bonds in the sterling market, more of which later. And in the US, the ARC has formally recommended a forward-looking SOFR term rate, although it continues to recommend overnight SOFR compounded in arrears or averaged in some other way for floating rate notes and for securitizations. The SOFR term rates may be used, however, where use of the overnight and averages of SOFR have proven difficult, and it might be used as a fallback to Libor where required. In the case of Japanese yen Libor, Quick Benchmarks has begun publishing production rates for a Japanese yen term rate as well. Now, looking at credit-sensitive rates, which are something that have come up more recently, and credit-sensitive rates are interest rate benchmarks that seek to measure the credit risk component of unsecured borrowing in certain markets, which, as I've explained, aren't observable in the risk-free rates, but were observable in Libor. Credit-sensitive rates have started to emerge as a possible alternative to US dollar Libor and to SOFR, but not so much in the bond markets, more so in the loan markets. And some of the credit-sensitive rates that you may have heard of are BSBY, which is the Bloomberg rate. It's a short-term bank yield index, Ameribor, and I believe there are others. Now, there's a concern with the CSRs that, number one, they wouldn't comply with the IOSCO principles for benchmarks, which basically require a robust underlying market and sufficient data to accurately and reliably represent the underlying market. So IOSCO are quite keen just to specify that they're not necessarily supportive of credit-sensitive rates. And this has been supported by the regulators elsewhere in the world, including in the SONIA market and in the dollar SOFR market. So they really should be treated with caution. Now, if the issuance of Libor-linked bonds is entirely unavoidable, then issuers have been strongly recommended to use robust fallbacks to risk-free rates because, frankly, we know that Libor won't be around for very much longer. In the sterling market, the end of Q1 2021 was a key milestone. It was the date after which no new Libor referencing contracts were to be entered into. So in the sterling market, and actually for some time now, Libor-linked issuance has more or less ceased, and the market has moved entirely to SONIA for new issuances. In the US, it's slightly different. Some transactions are still being issued linked to US dollar Libor, although this is diminishing. And the fact that US dollar Libor will continue to exist until the middle of 2023 is really only to support the wind down of legacy transactions. It shouldn't be used for new transactions. However, if it is, in the US, some transactions are including recommended fallback language, which the ARC recommended in April 2019. And that sets out a waterfall of fallback options linked to SOFR, the first of which is term. In Asia Pacific, the issuance of new Libor-linked bonds has continued in 2019 and 2020, and there's been a little in the start of 2021. Now, some of those bonds contain fallbacks, but some of them contain no fallbacks at all, which is a slightly more worrying situation. Okay, now this is part 4. We're looking at legacy transactions and the associated challenges. So first of all, what do we mean by legacy bonds? Well, legacy bonds are bonds which are linked to Libor of any currency, which are already in issue and are not due to mature before the end of Libor in the relevant currency. Tough legacy bonds are bonds which have contracts that have no or inappropriate fallbacks and which cannot realistically be renegotiated or amended, which is the definition used by the FSB, the Financial Stability Board. Now, looking at fallbacks, it's very important to assess what fallbacks your any bond documentation has, and they will be the key to how your bonds are treated. And most English law governed bond documentation, which references Libor, contains fallbacks, which typically falls into one of 3 broad categories. This is type 1 for start, type 1 fallbacks, which in the event of the non-availability of Libor which would be the case if it permanently ceases, would fall back to the rate in effect for the last preceding interest period, which essentially changes the bond into fixed rate bonds for life. Now, that would never really have been intended to cover the permanent cessation of Libor. It would have intended to cover things such as systems outage or some other temporary block on being able to access the Libor rate. So this isn't really a suitable fallback for the long term, and it wouldn't be commercially what the parties would have intended when they were drafting the bond conditions. The Type 2 fallbacks on the permanent cessation of Libor or certain other triggers, such as a prohibition on the use of the rate, will typically envisage the issuer appointing an independent advisor to select or advise in the selection of a successor rate and an adjustment spread to be applied to the successor rate, in each case on the basis of recommendations made by a relevant nominating body or customary market practice. The Type 3 fallbacks are the same as the Type 2 fallbacks, but they have an additional trigger of an announcement of non-representativeness of Libor by the supervisor of the benchmark. Now, this doesn't cover every case. It covers the majority of cases, but there will be fallbacks which may be worded slightly differently or which try to future-proof the demise of Libor and may end up having different trigger points and trigger dates in that case. But in general terms, if you have a Type 1 fallback, you're very likely to fall under the definition of tough legacy unless the bond can realistically be renegotiated or amended, which often isn't the case. If you have a Type 2 or a Type 3 fallback, the Sterling Risk-Free Rate Working Group, in its capacity as a relevant nominating body, has recommended a successor rate, which is SONIA compounded in arrears, and a credit adjustment spread. So if you have Type 2 or 3 fallbacks, they should operate in accordance with their terms and fall back to the risk-free rate, SONIA compounded in arrears. If you've got a Type 1 fallback, then we're going to look at some options about what the alternatives are. Now, consent solicitation is an option for Type 1 bonds. And essentially, a bond is a contract between an issuer and the bondholders, which can be amended with the consent of the parties. And that can be achieved by way of consent solicitation, whereby an issuer can propose certain amendments to a bond. And if the necessary quorum and consent thresholds are reached, then the proposed amendments can be made to the bond, and it will bind all the holders of the bond, irrespective of whether they voted in favour of the amendment or not, or if they purchased the bond subsequent to the date of the amendments being made. In the sterling market under English law, amendments to interest rate provisions typically require a quorum of 2/3 or 75% of the holders of the outstanding principal amount of the bonds. And if you get the quorum, 75% have to vote in favour of the extraordinary resolution to amend the bonds. Now, in the sterling market, this has been undertaken quite a lot. We've probably had between 75 and 80 Libor-linked legacy bonds, which have already transitioned successfully from sterling Libor to overnight SONIA compounded in arrears by way of consent solicitation processes. And there are currently about 8 in progress at the minute. This represents probably about, we think, 1/5 of the outstanding amount of bonds, although in terms of volume, we think it represents approximately half of what is going to be outstanding beyond 2021. Consent solicitations in the sterling market haven't always been successful, however, and there have been about 10 which have not managed to transition on that basis. They will probably become tough legacy. In the dollar market, under New York law, amendments to interest rate provisions typically require the consent of 100% of the holders of the outstanding principal amount. So the consent solicitation process is pretty uncommon and quite impractical in bonds governed by New York state law. And in the Japanese yen market under Japanese law, there's a similar process of consent solicitation. But bondholder meetings rarely take place in Japan, and so convening a meeting to transition Libor referencing bonds is not likely to be familiar to many Japanese market participants. Now, when it comes to looking at consent solicitation, we have been trying to assess the feasibility of transitioning more of the market before the end of 2021. But there are a number of challenges. It's not a particularly straightforward process. First of all, the quorum and the voting thresholds can be difficult to achieve, especially if the bond being transitioned is widely held by a large number of investors, not all of whom could be located or are prepared to engage with the process. And if there are large volumes of consent solicitations taking place at the same time, that can pose quite a logistical challenge trying to get the different requirements. Typically, under English law, these transactions can take some time. They can take about 2 months from start to finish. And some of the timings are actually set out in the bond documentation. And for instance, you might need court approvals, such as in Japan. And a lot of those cannot be circumvented. So it's important to actually think about the timing and do as much of the upfront work as in advance, just to try and be as efficient as possible with respect to expectations for the outcome. It can be costly to undertake a consent solicitation, and the cost is usually borne by the issuer. So issuers will want to ensure that before they do it, the consent solicitation will be successful, but there's no guarantee that it will be. Some inefficiencies have been highlighted in the process, such as difficulties in locating the bondholders and the requisite cascade of information and communication between the parties, which should be straightforward, but actually isn't. And it can be compounded when you have different ownership structures in place. So much of the operations process is conducted manually, and if that were to be exacerbated with large volumes of consent solicitations within a relatively short time frame, it just wouldn't be feasible. So there are other challenges, such as investors might want to hold out in favour of a more favourable outcome, or sometimes bonds migrate into different jurisdictions where they shouldn't have migrated, and therefore it renders their holders ineligible to vote in the consent solicitation. And on a securitization, there's a need to ensure that all the various different instruments which together make up the securitization, such as the swaps and the liquidity facilities or other credit enhancement arrangements, all transition at the same time and in line with the bond itself, and that there's no impact on the rating of the bonds issued as part of the securitization. So in many ways, not necessarily a very straightforward and easy process in all cases. So in view of this, and in view of the fact that there will be a number of bonds which will remain outstanding, the Financial Services Act in the UK amends the benchmark regulation, and it empowers the FCA in certain circumstances to direct the administrator of Libor for sterling Libor and Japanese yen Libor to change the way in which it's determined to so-called synthetic Libor for up to 10 years. And synthetic Libor is going to be based on term SONIA plus a fixed credit adjustment spread. So this is one of the instances in which term SONIA is permissible. It's not yet clear exactly who will be permitted to use synthetic Libor or exactly which type of securities it will apply to, but an outcome on this is expected imminently, maybe next week. In the case of Japanese yen Libor, the FCA is consulting on requiring the administrator to continue to publish a synthetic version of Japanese yen Libor after the end of 2021, but only for one additional year. So Japanese yen Libor will cease absolutely on the 30th of December 2022. And that is a bit of an issue in the Japanese yen Libor market, because there are a number of bonds which will remain outstanding after that point, and quite a few of which have no obvious fallbacks. And given the difficulties with consent solicitation in Japan, which I've just mentioned, there may be some market disruption or associated problems in that market. In the US, there is going to become a law which basically prohibits parties. Well, it basically ensures that for when you see SOFR, when you see US dollar Libor, you read SOFR. And so that is sort of called contract override. And this legislation also provides a safe harbor for the market from any litigation that arises as a result of using the recommended benchmark replacement rate, which has not yet been specified. In the euro area, the EU benchmarks regulation allows the European Commission to designate a benchmark replacement that covers all references to Libor. Now, just a brief look before we wrap up at the interplay of bonds and derivatives. And in the derivatives space, ISDA has conducted a number of consultations on fallbacks to IBORs in the ISDA Master Agreement. And the chosen fallback is to SONIA compounded in arrears, which obviously aligns with the bond market. ISDA also consulted on what the credit adjustment spread should be, which would be applied to the fallback rate to replicate the economic element. And the rate chosen there was a historical median over a 5-year look-back period. And these have been implemented by way of the ISDA protocol and fallback supplement into the ISDA Master Agreement. So this is significant for the bond market and actually for the loan market, because for bonds which have already transitioned to SONIA by way of consent solicitation, there should be no mismatch with the associated hedge if the contracting parties have also adhered to the ISDA protocol. But for those bonds which have not transitioned or which are hoping to rely on the tough legacy solution of synthetic Libor, there could be a mismatch with the associated hedge if the counterparty has adhered to the ISDA protocol and has not specifically excluded that hedge. This is because you adhere to the protocol, you fall back to SONIA compounded in arrears. But if you use the tough legacy solution of synthetic Libor, your rate will be a term-based rate. So there's going to be, well, hopefully there won't be many, but it could give rise to some hedge mismatches, which will need to be renegotiated. The only final point that I'd like to pick up, which isn't in the slides, is just the interplay with the loan market. Now, we are a bond association, but we have worked closely with the LMA on Libor transition in loans. And for quite a long time, the transition and uptake of the risk-free rates in the loan market was very, very low, on the basis that operationally, it's much more challenging in the loan market to use a compounded in arrears rate than a term rate. In both markets, it's required quite a bit of system updates and implementing new systems, but the bond market was able to adapt more quickly. However, the loan market has caught up, and now there are a number of facilities which are being entered into, either referring to risk-free rates directly or containing some kind of switch mechanism, whereby when Libor ceases, there'll be an automatic switch to the risk-free rate. And the same points which relate to the ISDA and the hedging mismatches also relate to the loan market. Finally, I know the loan market are doing some work on the transition of a lot of their legacy transactions as well, which should be an easier exercise in the loan market because you have fewer parties than if you had a public bond issuance. I'm going to stop there, but I'd be delighted to take any questions. I had a few come through earlier on. So there was a question about the practical alternatives to Libor and how they are supposed to avoid the disadvantages of Libor. I think fundamentally the fact that the alternative rates, the risk-free rates, are overnight rates, which are observable because they're based on actual transactions, means that there's not much element of subjectivity, and that will avoid the subjective nature of Libor and will ensure that it cannot be capable of manipulation. The only thing I would stress is that the credit sensitive rates are not quite as robust as the risk-free rates such as SONIA and SOFR, because they do contain that subjective credit element, which is why regulators are keen to stress that they should not be used. Operational risks of Libor, shall they be avoided in the alternatives? We think so. I mean, I've been through some of the operational issues with using risk-free rates over Libor. It has required a change in systems, as I said, and systems upgrades. It has also required a change in mentality because, in fact, the bond market has been using the term rates for such a long time now that it requires a complete change in approach. And also it requires, for instance, smaller issuers, and particularly in the loan market, to do a bit more around cash management, because they're not necessarily going to know at the start of an interest period what their liability is going to be for that whole interest period. They won't know that until close to the end. So they are operational challenges, but we understand that, there's nothing insurmountable, and a lot of the challenges have been taken on and addressed. So another question about impacting loan products and bond products. I think I've probably covered off a little bit of the loans there, as well as the bond issues. A question about Libor transition affecting CSDR regulation. I'm not going to address that because I'm not really very familiar with CSDR regulation. However, I can pick this up with colleagues who are very intimate with it and can take this further if you would like me to do so. My contact details are on the screen together with my mobile phone number. And this is how you would find more information on our website. We have the benchmark reform page. We update that almost weekly. We also have a distribution list, which we use to send out updates of information from among our membership. So if you would like to be included on that, that's also something that we tend to send out weekly, depending on the number of developments. So please do get in touch if you'd like to be included on that. Thank you very much for listening to me and for your participation and for your questions.